Hickey, Bespoke Investment Group co-founder. Hi, Paul. I mean, just objectively speaking, of course, it was a pretty bearish year. We did get to certainly bear market levels in the first part of it, but also it's been the mood that's also been dominated by the bears. What are you looking at here?
Yeah, so I mean, just as far as sentiment, I mean, you look at just the AAI weekly survey, you have bearish sentiment or bullish sentiment below the historical average every week this year. That's never happened in the history of the survey. You've never had a year where it's been below its historical average every year. So we have a real sense of malaise on the part of investors. There's a malaise in the economy, and there's just a malaise everywhere we look. I looking for my cardigan sweater today just because I kept thinking about malaise so much. But we're in the process of looking ahead to 2023, and there's really not a lot of positives. And it's bad when the best thing you can look at is you look back at prior years like this year, and you see that the last two times we were down 20% year to date, and then down in December. Were 2002 and 1974. The year that followed both of those periods was positive, and that's the thing. When you are near market low and there's nothing positive to point to and say this is why we need to rally. People are negative in all aspects. That doesn't mean we will rally from here, but it's just when you can't think of anything positive to find, that's usually the case when you're closer to a low than a high. The economy, go ahead.
No, I was just going to say, I mean, I would repeat that there are lots of concerns about this market and the outlook, but one of them is not that people's expectations are too high, it would seem, just in general in terms of Wall Street strategists and as you say, retail investors saying that they're quite bearish. And by the way, for anybody who's younger than us, the malaise cardigan reference was to Jimmy Carter several decades ago, and it was a good one. But how to read the sentiment flow in general? Because you could look at prior times this year when we were similarly kind of skewed to the pessimistic side, and it only gave temporary relief to the markets.
Yeah, no, I mean, sentiment is just one aspect of things. I mean, the main driver is the Fed. I mean, that's no surprise to anybody here. And the Fed is talking more hawkish than they've ever talked at this point. There's a little bit of a difference, though, between what we've seen this year throughout the year. For the first 3 quarters of this year, the market was constantly playing catch up to the Fed. Pricing of Fed expectations was constantly, for the terminal rate, was constantly rising. Since October, we've seen that pricing flatten out to even decline slightly. So that's the market thinking that they've caught up to the Fed and we're not being, trying to completely play catch up. The Fed seems to think that the economy is a lot stronger than it is. I mean, all we have to do is look to your last segment. You have former billionaires now living at home with their parents. So that's how bad things have gotten at this point. But on the inflation front, there's all signs seem to be pointing towards weaker inflation at this point. Obviously, yes, services seems to be stickier, but I think in this respect, there's a very real likelihood that you're going to have CPI with a 3 handle come early next year, and you're going to have a Fed funds rate close to 5%. And that is pretty restrictive territory. And so as long as the Fed doesn't ratchet things up a little more here, I think we can stay in at least this range-bound area that you've been discussing so much. The market really hasn't done anything in over 6 months.
That's right. And I do think it is still interesting that if you really do separate out either just all of tech or just the very largest growth stocks from the index, it's been a much less dramatic story on the downside. Whether that continues or not is difficult to say. But that group hasn't really gotten much cheaper, if at all, relative to the overall market, in the last year of trying, so to speak.
Right. So, yeah, like you said, the average stock is up 4% since the last time the S&P was at this level in June. So, underneath the surface, we've seen a little bit better performance. But the tech in general, it's gotten a little cheaper relative to the market, but it's still trading at a premium, an above average premium to the market versus history. Whereas other sectors like, materials, healthcare, and financials, which are much more reasonably valued relative to their history. So I think in that respect, you can see you have to take it sector by sector and even stock by stock, especially in the tech sector.